The interesting one tomorrow is we're putting out floating rate bonds, which is a different angle really. Not only is it fixed versus floating rates, and floating means that the coupon moves up and down with interest rates, so you're not sensitive to interest rate movements that the RBA might make. Basically, if they increase rates, your coupon will be higher. If they decrease rates, your coupon will be lower. So that's floating rate notes, and so I think people have a good understanding of that from other floating rate instruments. The difference here being is they are senior bonds, and therefore their capital stability is very, very stable on a relative basis. They basically, if you look at the last 2 years of the Bank of Queensland floating rate note that we're bringing out, or the XTB over it, its last 2 years is very, very stable. National Australia Bank is a bit less stable, but it really doesn't track an awful lot, very far away from the $100 par value. That brings in a new angle for us, which is, well, if it actually stays around $100 for the life, and it might go to $100.50 and back down again, then it can actually become a cash management tool. So a lot of people have got cash that they don't want to invest in equities or hybrids or property, but they need access to that cash. If you have an instrument on the ASX that is really quite, you could call it boring, because it just stays at $100 or thereabouts for the life, which might be a year, 3 years, 5 years, but it basically stays around that level, then you could actually see that as is that a listed cash investment? Cash is either in short-term bank accounts, like short-term term deposits, or at-call cash investments, like a cash management trust. You could actually see this as a listed version of that, where you could say, well, I'm going to sell cash, my Bank of Queensland floating rate note, and buy BHP shares, because I'm a regular trader. And my settlement will match up in chess, and there I go. So floating rate XTBs add a new dimension to what we've done. There is long-term investing, fixed versus floating, and there's choice there. And this brings in, well, actually for very short-term cash investment, that none of the other securities, you couldn't put your money in BHP shares and treat that like a cash investment, because it'll go up and down. And you need your money in cash to be $100, to be close to $100 when you take it out. So none of the other instruments in ASX really do that, the main body of ASX traded securities. This brings in an opportunity. There is one other that I'm aware of, but basically there's not a lot of listed cash type of opportunities, and there's an awful lot of money in cash. So there's billions in cash management trusts and cash management account, and many billions in very short dated term deposits. So this gives those advisors an option to say, well, what are the yields? The yields on these floating rate instruments are between 2.6 up to 3.2 in the short term. If you hold longer term, they're to maturity, they're slightly less. But if you're a short term investor, 2.6 to 3.2, and you've got money in cash for 6 weeks, then you'll be weighing up, well, do I put it in a cash management trust over here earning 1.8, or can I put it into this instrument and earn 2.8, 3.2, whichever one you pick, which is obviously higher. And the slight difference being is that this one will move slightly around $100, so it might go up to 50 cents or down to $99.50, whereas $100 in the bank is $100 in the bank. But people will weigh up the balance there between, actually I'm getting a much better return for this relative stability. I'm getting 3.2% versus 1.8. I think I'll go for that. Or somebody might say, no, I need my $100 to be exactly $100. I don't want to take the 50 cent risk, basically. But they'll weigh that up, and advisors will weigh it up, and they might say, well, I'll need some money in a cash management account, but I'll move some of it into a market environment and get the better returns.